In this lesson, how to trade pennants and flags, the learning objectives are you should understand the difference between pennants and flags, and you should know how to properly enter a trade using pennants and flags. Flags and pennants are popular continuation patterns, meaning that you would expect the trend to continue after you see this pattern. Flags and pennants closely resemble each other. The main difference between the two is that pennants consolidation period resembles a triangle, while the flags consist of two concurrent lines which give a slope from the initial trend. Concurrent means parallel lines, but you'll see an example anyway. This is the reason the terms flags and pennants are often used interchangeably. These patterns are usually preceded by a sharp rally or decline, and mark a midpoint of the move. The first pattern we're going to look at is the flag. A flag is the pattern that consists of a channel of parallel trend lines that go against the previous trend. If the previous move was up, then the flag would slope down, and if the move was down, then the flag would slope up. This is one of the easiest patterns to spot, and also one of the most useful in your price action analysis. Not only will this help you find and manage trades, but also analyze what the market is looking to potentially do next. Let's look at a bullish flag. The bullish flag is created when the price is in a strong trend higher. As you can see with the red line, it is going up. Price will make a strong move higher, creating the pole, and then consolidate sideways, creating the flag. Whilst the sideways consolidation and formation of the flag will often be angled lower for a bullish flag, it can also be directly sideways in a horizontal shape. Bearish flags is created when price is in a strong trend lower, as you can see with this red line here. This creates the pole, and then it would consolidate sideways, creating the flag. Whilst the sideways consolidation and formation of the flag will often be angled higher for a bearish flag, just like for the bullish flag, it can also be directly sideways in a horizontal shape. Now let's look at pennants. A pennant chart pattern is a continuation chart pattern that is created when the market makes a large move, either higher or lower, and then begins to move sideways and consolidate. During this sideways movement, price begins to squeeze, with converging trend lines creating a pennant that will often form a triangle. Pennants may be small in size, but they often signal huge price moves. The size of the breakout move is roughly the size of the earlier move. Here we have a bullish pennant. They look to move in the same direction as the trend, as the way the price was trading before. So what it means is that, as you can see, because it's a bullish pennant, there was a sharp move higher. Then there was a pennant, which is a triangle, a converging triangle pretty much, and then you would expect there to be the trend to continue, so you would expect another move higher. Here we have the bearish pennant. A bearish pennant is the same as a bullish pennant, but inverse. So after the price has fallen, and you see these two trend lines converging, forming the pennant, you would expect the price to continue going downwards in the same direction as the initial trend. For both of these, you enter at the break of the flag or pennant in the direction of the preceding trend. There's two types of entries you can do. The simplest way to trade breakouts is just with the simple breakout trade setups in line with the trend, whereas a conservative entry involves looking for price to break out, then retest the old flag pennant trend line, which could either be a high or a low. and then wait for it to act as a new support or resistance level to finally trade. I would suggest an aggressive entry for pennants and flags because they often break out and then don't come back down. Your profit target, as we've done for many other chart patterns, is just the length of the flagpole, and then you would use it to estimate the advance or decline. The flagpole being the initial move higher, and then you would just add this to your entry. And then for your stop loss, you place it at the opposite end of the pattern. But if that stop loss is too big for you, you could just place your stop loss in the middle of the pattern. Because if the price was to hit your stop loss, you should think of it as invalidating your pattern, so it is better to get out of the trade than stay in. In conclusion, trading flags and pennants isn't anything new to most traders. However, if you are able to identify another perspective on the formation, you are essentially developing an edge over other market participants. It is important though you stick to the identification guidelines. So you should always make sure that the flags and pennants are preceded by a sharp advance or decline. Without a sharp move, the reliability of the formation becomes questionable, and trading could carry added risk.